This video will help you understand if you should be tracking your medical expenses throughout the year. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Now, I get it. Most people do not like tracking their onesie-twosie monthly expenses on some sort of cash flow software or whatever. It's time consuming, it's akin to budgeting, and we all know that we're probably going to find unpleasant truths that we would rather just go along our lives not knowing about. Such as maybe your spouse spends $300 a month on Starbucks, or you spend $1,000 a month on suits. But I digress. The purpose of this video is not to discuss the merits of cash flow planning, but rather to discuss the efficacy of tracking one particular line item, namely medical expenses. So we'll break down 3 demographics of folks that if you fall into those camps, it's probably going to be in your best interest to look into tracking medical expenses throughout the year. So let's jump in. Outside of the proverbial, you should probably know at least where your money is going roughly on a monthly basis. Specifically as it pertains to medical expenses, there's 3 categories of folks that this is going to be of high importance, and medical expenses should get some additional love and attention when it comes to tracking. Category number 1 are going to be for those folks who itemize deductions on their tax return, or if they should be. Number 2 are going to be those who have health savings accounts established, whether or not they're still funding that HSA. And number 3 are going to be for those who have some level of discretion over picking which health insurance plan they enroll into. So first up, for those who choose to itemize tax deductions, or they should be, as a quick refresher on itemizing tax deductions, every year when you send in your tax return to the IRS, as you're preparing your return, you're given the option for how you want to lower your adjusted gross income to form taxable income, which is ultimately what you pay taxes on. You can either choose to itemize deductions, or you can choose to take the standard deduction. Generally, if you want to pay the IRS as little as you have to legally, you'll either choose itemizing or the standard deduction based on whichever one gives you the largest summation. For reference to 2023's numbers, married filing jointly folks, their standard deduction is $27,700. For single folks or married filing separately, your standard deduction is $13,850. And for those who file as a head of household, your standard deduction is $20,800. So if itemizing produces a higher summation than that relative standard deduction, if you want to pay the IRS as little as you have to, you'll probably opt into itemizing your tax deductions. Now for context, it's around 90% of taxpayers take the standard deduction each year. Now, is that because financially that was in their best interest? Or is it partially because most people are a little bit lazy in tracking their expenses? Most people end up filing their return the day before it's due, and the quick and easiest thing to do is just to check the standard deduction box. I don't think we have any way of really knowing which strategy produced the best results for someone after the fact. But needless to say, if we are tracking our medical expenses, which is an itemizable deduction, you'll at least be in a better position to make an informed decision come tax time. Now, a few things to note if you are going to itemize deductions, specifically as it pertains to medical expenses. Unfortunately, you don't get to include all of your medical expenses as itemizable deductions. You're only allowed to get credit for or count on your itemized deduction worksheet medical expenses that exceed 7.5% of your adjusted gross income. So only the amount you spent above and beyond that threshold is included on your Schedule A of Form 1040, which is where you calculate all this. So for example, if in 2022 your adjusted gross income was $200,000, 7.5% of that is $15,000, which means only medical expenses above and beyond $15,000 would be given to you as credit towards your itemized deduction summation worksheet. All this falls onto Schedule A of Form 1040, which I'll link down below for reference. To learn more about how the IRS defines a medical expense, you're going to want to see Publication 502, which I'll link below. Now, rest assured, your itemized deduction summation is not solely due to how much you spent on medical expenses. There's other itemizable deductions, things like home interest deductions, state and local taxes to a degree, as well as gifts, etc. We'll do a video another time on itemizing deductions and some more of the specifics there. However, for reference to what is itemizable and would count toward that total summation that you'll run, you're going to want to see Schedule A of Form 1040, which again, I'll link down below. Now, like I said before, tracking medical expenses is by no means a guarantee that your itemized deduction summation will be a higher number than the standard deduction. However, if you aren't giving your itemized deductions a chance to exceed the standard deduction, well then of course you'll never exceed the standard deduction. Whereas if you are actually tracking your medical expenses, among those other things too, you'll have a better opportunity come tax time to truly make an informed decision as to which strategy is in your financial best interest, assuming financial best interest is paying the IRS as little as you need to. Now, the second reason why you might want to be tracking your medical expenses are for those folks who have health savings accounts established, whether or not they're still actively funding those accounts. Now, as it pertains to health savings accounts, we'll do a video another time on how these specifically work as it pertains to taxes and investing them, etc. But needless to say, the HSA is an account that you fund, it's not use it or lose it, and you can invest the money inside the health savings account to grow and compound with whatever the underlying funds of your investment are. In addition, you can pull out HSA funds to reimburse yourself for out-of-pocket medical expenses that you incur. And when you do that, when you pull money out of the HSA for a qualified medical expense, that money comes out of the HSA tax-free. Now, most people that I've run into use the HSA to reimburse themselves for medical expenses incurred in that same year. So let's say I had some procedure done here in 2023, I might choose to pull money out of my HSA to reimburse myself for whatever out-of-pocket costs I had relative to that procedure. That's what a lot of people do. However, there is no rule that says you can't reimburse yourself for past medical expenses incurred in previous tax years. The only rule is as long as your health savings account was established before you incurred said medical expense. So for example, let's say in my 30s, I open up a health savings account, I put some money into it, I invest it, and it starts to compound. And let's say I don't touch that until I'm in my 60s. Now, of course, I've had medical expenses between the ages of 30 and 60 in this example, but I'm choosing to pay out of pocket for those out of my bank account and my income rather than pull money out of my HSA. Now, HSAs grow on a tax-deferred basis. So while yes, I'm paying out of pocket for these medical expenses, my health savings account is compounding and growing similar to an IRA on a tax-deferred basis. And since there's no statute of limitations on how long it can have been since I incurred a particular medical expense, as long as the HSA was established before then, I could theoretically, in my 60s, pull money out of my compounded and much larger health savings account in the future to reimburse myself for medical expenses I incurred in my 40s and 50s. Now, this may or may not be in your best interest. However, this is oftentimes why it's recommended to at least establish a health savings account if you're enrolled in a high deductible health plan as quickly as possible. Whether or not you're continuing to fund it, whether or not you are still enrolled in the high deductible health plan, doesn't matter. You had the health savings account opened as early as possible, which means you have more of your life that would qualify for health savings account reimbursements at some point in the future. And for the engineers out there, the math would show, as long as it's not going to financially devastate me to pay out of pocket for my medical expenses today, the math would show that letting your health savings account compound and tax defer is a long-term financially superior strategy than pulling money out of my health savings account in years when I don't necessarily need it just to reimburse myself for medical expenses because I can. Economically, you could look at paying out of pocket today for medical expenses as a form of saving into your health savings account, but the math is essentially the same as funding a tax-deferred retirement account versus funding a taxable non-retirement account, but not touching either one until they're 60. Obviously, the one that grows without taxes would have a net higher return, assuming they're invested in the same stuff. For more information on what you can or can't use your health savings account for, check out publication 969, which I'll link down below. The last demographic of folks who might want to track their medical expenses are going to be those who have some level of discretion over their medical plans that they can pick every year. Now, for most W-2 employees, this is going to come around during open enrollment time where you'll have choices between, low deductible, middle deductible, and maybe high deductible health plans. And for my self-employed clients, you have full discretion over which medical plan you enroll into. And so this is going to be particularly relevant. And the reason you're going to want to track medical expenses is particularly so that you can understand which health insurance plan is right for you. This has nothing to do with taking tax deductions, funding HSAs, etc. It has more to do with not overpaying for a health insurance plan for too much insurance that you don't need, or accidentally opting into a high deductible health plan so you can open and fund a health savings account. Understanding how much you spend on medical expenses for this demographic has less to do with tax efficiency and far less to do with funding an HSA and more to do with not overpaying for insurance that you don't need for your particular situation. If you're tracking your medical expenses throughout the year, come open enrollment, you'll be able to make a more informed decision as to which plan best serves the needs of you and your family. Drawing up the dichotomy here, for example, if you spend a ton on medical expenses throughout the year, or you anticipate doing so in the future, childbirth, etc., it's probably not going to be in your best interest to enroll in a high deductible health plan. On the contrary, if you end up spending quite a little bit on medical expenses throughout the year, you could probably run the risk of opting into a high deductible health plan, of course making sure you have all the other provisions in place like an emergency fund, etc. And when you're enrolled in a high deductible health plan, well, now you can opt into setting up and funding a health savings account, assuming the high deductible health plan meets the IRS limits, which I'll link down below. Because in order to fund a health savings account, not necessarily open it, but to fund an HSA, you do need to be enrolled in a high deductible health plan. And the IRS has a definition for what meets that high deductible health plan based on certain out-of-pockets and things like that, which I'll link down below. So calls to action wise, of course, I think it's a great idea to track your monthly cash flow and everything you spend your money on and have it in categories, etc. That's what I do. I'm a bit of an engineer about it, so I enjoy that. But I realize for most people, that's not enjoyable. And I also realize that it's not practical for a number of folks for one reason or another, or maybe they just realize they're not going to actually do that. So at a minimum, it would make sense to track your medical expenses if you fall into one of the three aforementioned camps. And if you are tracking medical expenses, one more thing would be to track the payment receipts, because that's ultimately what you're going to use if ever, for example, you decide to reimburse yourself from a health savings account. You're going to have the proof. Now, is the IRS going to come knocking? Maybe, maybe not, but if they do, you'll have the backup ready to go. So hopefully that was helpful in explicating why tracking your medical expenses can be in your best interest. If you have further questions, drop them in the chat below or get in touch on the website. Have an awesome rest of the week. We'll chat with you later. Bye.